The S&P 500 just hit the highest high of all time. It broke 5,000 points, which is just monumental. It's a moment in time that history has been made, which is pretty cool. But this is actually very scary for those of you who are investing in 2024. The sentiment around big banks and institutions is that 2024 is gonna bring the biggest crash of our lifetime. Risk in the stock market is actually at an all-time high. It doesn't feel like it because things are going so well. And if you had invested $10,000 a year ago into the S&P 500, your $10,000 would now be almost $12,300, making you $2,300 in just 1 year from passive income. But today, we're at the height of the market. And there are literally hundreds of reasons why this stock market is actually on very thin ice, and it can break at any minute. This video is gonna explain some of the biggest concerns. It's gonna explain how you can stay safe during this possible recession and market crash. And then we're gonna explain our exact strategy for the next couple of months. The stock market could plummet, and so, while continuing to passively invest into funds that I believe in like VU or SCHD, this is not financial advice, I'm also waiting to invest the bulk of my money for a couple of key things. More people are being laid off or fired in 2024 than expected. Newsweek reported that more than a fifth of Americans are without any savings, and another fifth have less than $11,000 in their bank account. U.S. workers are getting scooped up by international companies, which may hurt the U.S. stock market. Delinquency rates on credit cards and auto loans have spiked to their highest since the Great Recession. We know a few bankruptcy lawyers, and I remember seeing these signs in 2008 leading up to 2009, as back then, credit card delinquency rates went up, and then auto loans delinquencies went up. At that point, the fall came very quickly. If people can't pay these bills and then they get caught up in that high interest debt, then the only thing left for them to do is file for bankruptcy. And at that point, the stock market crashes quick. Credit card debt that moved into serious delinquency, which is 90 days past due, was 6.4% in the fourth quarter of 2023, which is a 59% jump from just over 4% at the end of 2022. Job postings are down 15% over the past year, plummeting 31% in finance and 44% in software development roles. If unemployment rises, that's another big sign for a recession. So, all those and more are just things that are happening outside of the stock market and macroeconomically as a whole. Looking at the actual stock market though, things are even very scary there. Yes, the S&P 500 and most major indexes are up big this year already. But specifically, the S&P 500 is being propped up by just 7 companies. The Magnificent 7 accounted for 45% of January's S&P 500 return. The Magnificent 7 comprises of Apple, Microsoft, Amazon.com, Nvidia, Meta Platforms, Tesla, and Alphabet. The obvious problem there is that if any of those companies are to stagnate or possibly fall, that's gonna make the S&P 500 and stock market overall drop as well. Now at this point, with all this volatility, some are looking to hedge funds because at that point, at least somebody professional is going to be managing your money and maybe they have more insight than you. They move your money outside of certain funds if they start to see the data or trend showing that that's going to drop so that you don't lose as much money. And then you put that into a different fund or a different place so that, hopefully, we can maximize on the gain. There is definitely something very interesting about this that the finance industry does not want you to know. But I'm gonna tell you, and this is going to make you very rich. First, though, we all invest to increase that net worth and to hopefully have some savings or safety down for a rainy day. There is another thing we need to keep in mind as far as financial planning. One thing you can consider is life insurance. life insurance is just so important to keep your loved ones safe and secure. It's a bit of a side note, but it is something to consider if you have family and or dependents you need to take care of. Back to the topic at hand, like I said, right now being at the top of the market where the S&P 500 is hitting all-time highs. It's a time that we're starting to think what goes up probably has to come back down. We can't just leave our money in that fund, can we? Shouldn't we use hedge funds to hedge our bet and let professionals do their job and make us some money? Well, Financial Times reported some interesting data. Over the past 5 years, investors have pulled over $5 billion from equity hedge funds. An investor who put $100 into an equity long-short hedge fund 10 years ago would now have an average of about $163. Had they invested in Vanguard's S&P 500 tracker with dividends reinvested, they would have $310. You can see very clearly here that the S&P 500 has outperformed, as the S&P 500 is in navy blue while the hedge fund is in light blue. One of the big reasons for the outperformance is the fees associated with the hedge fund. That chart that we just looked at was showing performance including the fees. So, what am I gonna do with all this information? The first thing that I've actively changed is that I've actually started to add just a little bit more into my high-yield savings accounts, with the rates still very high until the actual rate cuts start to happen. It's a no-brainer to hold your money in these high-yield savings accounts and get a guaranteed 4 to 6% on your money. The reason that I'm adding more here is twofold. Number one is just safety. It gives so much peace of mind to even have one extra month of living expenses just sitting in a guaranteed account like that. Number two, though, is just betting that the stock market might actually drop. Now, we do not advocate for timing the market in general, but this is almost a hybrid strategy. And I'll explain that further by telling you exactly the rest of what I'm doing here in 2024. So, as far as investing, like I mentioned earlier, I'm still dollar cost averaging into the ETFs that I believe in wholeheartedly. The S&P 500 is at all-time highs, but it's also been at all-time highs hundreds of times, and statistically, those were great times to invest. Looking back on it now, for example, as you can see on June 5, 2015, the market was at an all-time high, the absolute highest it had ever been, at $2,092. Now, yes, by October of that year, it had dropped to $1,950, which at the time would have seemed terrible. But just 1 year later, in October of 2016, the market had reached new all-time highs and now at $2,141. And then less than 9 years later today, the market is at over $5,000. So, investing at the absolute top of the market in 2015 would have increased your wealth by over 250%. Let me say that again. Investing at statistically the worst time, at the absolute top of the market, still would have increased your investment by over 250% in less than 10 years. And we see this over and over and over again with the S&P 500 because it has so much history and because it's been through so many recessions and recovered. So yes, we are at all-time highs today and our human psychology is saying we're at the top. This is kind of scary, it has to drop, and it probably will drop. But as the saying goes, time in the market is better than timing the market. We just have no idea when it's gonna drop, if it's gonna drop, and if so, how much it's gonna drop. But keep in mind, this is because we believe in the US economy and don't see it failing anytime soon. So we're open to taking the risk. I am continuing to invest every single month into my 3-fund portfolio of an S&P 500 ETF, a dividend ETF, and a mixture of growth ETFs. As far as my moderately hybrid strategy, since I do believe that timing the market beats timing the market. But I also believe that this market is bound to drop a bit, and there's a possibility that it drops more than a bit. with my total amount of investable income or disposable income. I'm putting about 80 to 85% of that into my 3 ETF portfolio. But then, I'm setting aside about 15 or so percent into the high-yield savings account for a rainy day. If the market does drop considerably, like 20% or more, I'll take all of that money from the high-yield savings account and throw it directly into my 3 ETF portfolio. With this being an election year and with all the stats that I highlighted before, this year will definitely be an interesting one, and so I'm setting myself up for the best possible outcome. Keep learning and keep growing. If you found this video to be good, leave a thumbs up. Remember, financial freedom starts with an adaptable mindset. See you in the next video. Cheers!